And then we're going to see, frankly, opportunities, I think, in the institutional side, where institutional owners are going to look to monetize net lease assets, to harvest capital equity on their balance sheets.
I'm here today with Joey Agri, President and CEO of Agri Realty Corporation. What is Agri Realty's perspective on long-term debt pricing, and how has the company positioned its balance sheet in response?
Well, I think the second half of the question is probably the most relevant today. So our balance sheet is well positioned with over $1.5 billion of liquidity as of September 30th, with $250+ million in cash on hand, zero outstanding balance on our revolving credit facility, and then over $300 million in forward equity. So with the dysfunction and dislocation we're seeing in the long-term debt markets today, our balance sheet and our assumption is that they won't return, frankly, too quickly, the debt markets, to a viable option. But we're prepared for all types of events or all types of circumstances in the macroeconomic environment.
And to what extent do you see potential opportunity coming from distressed assets across your core markets?
Well, I would say distress will come in many forms. I think we're going to see transaction volumes across commercial, let alone residential real estate, single family, as well, shrink in terms of transaction volume dramatically. Obviously, with interest rates being where they are today. And so distress comes in multiple forms in our market. One, divorce, the 3 Ds. Divorce, debt maturing, death. And then we're going to see, frankly, opportunities, I think, in the institutional side, where institutional owners are going to look to monetize net lease assets, to harvest capital equity on their balance sheets, to reinvest in their broader asset pool or broader asset class. So we're going to see a transaction market that dramatically, we're already seeing it slows down. We're going to see a limited buyer pool out there in that transaction market. And then we're going to see opportunities from the 3 Ds, as well as from institutions, REITs, non-REITs that need to harvest capital.
And what are some of the attributes that you think retailers will need to have to navigate the year ahead?
Great question. Depends what the year ahead truly brings. I think there's a wide spectrum of potential outcomes, obviously, given the macroeconomic conditions we see. I think most importantly, retailers have to have a core purpose. That core purpose has to have a non-discretionary nature to it. So if you're a retailer today that doesn't carry groceries and you're a general merchant, you have challenges ahead, i.e. some of the department stores or even off-mall, such as Kohl's. And so retailers have to have a defensible market position. They have to have a balance sheet that is extremely flexible. And they have to have that core value proposition for a consumer to drive traffic in the store. So we all know retailers are moving toward an omni-channel world, trying to drive that same day, same hour delivery to the store to frankly limit margin erosion. But to do so, they have to have that storing strategy that's based on necessity. And so the Walmarts and the Targets of the world, they carry that core necessity in grocery to get you to buy soft goods. So we obviously see over-inventoried a number of retailers, but those retailers that don't have that necessity or value-based proposition, it could potentially be a very challenging environment.